think the biggest mistake depends on what kind of investor you are. If you're a growth investor, the biggest mistake is probably just to envisage that something will go, to great new heights that it never gets to, and not to anticipate that things can go wrong on a growth story, perhaps. If you're a value investor, the biggest mistake is likely to be, it's not likely to be overpaying, it's likely to be buying a company where the fundamentals deteriorate. In other words, it's cheap for a good reason, the value trap. I think that's the most likely mistake a value investor can make, and something that a value investor always needs to be very wary of, because certainly a value investor is not so likely to just simply overpay for something. The source of mistakes is interesting. Sometimes they can be simply because a lack of independent analysis, where people are drawn to following the crowd, and jumping on the same bandwagon as everyone else. As I think Warren Buffett says, stocks are the only things that people like more the more expensive they get. They don't go out and buy more vegetables when the price goes up; they buy less. But in the stock market, it has a sort of a self-reinforcing pattern where something goes up is therefore seen as a good investment, so everyone should be in it. And of course, it works the other way on the downside; it goes down, and therefore everyone should be out of it. And that momentum is then a genuine feature of the market, and something that I think all investors have to be wary of, because it's perhaps the most dangerous trap of all.
And I'm just curious, how do you go about avoiding some of these mistakes, or specifically, how do you go about improving your judgment, and, for example, recognizing what is a value trap and what is just a business that's fallen on temporary hard times? But can you tell us a bit about how do you improve your judgment as an investor?
It's clearly an area that there's no simple answers to. As you say, it's a question of improving your judgment rather than getting it right every time. You just have to look at what you think are the causes of a problem, and whether they're fixable or not, or whether they're within the management's capacity to fix, or whether they are structural and are likely to move in the wrong direction irrespective of what management does. You then also have to be confident that management are going to do the right things. So an example at the moment might be Tesco, for example, where it's had some problems. It issued a profits warning for the first time, I think, probably in its entire history. The share price fell significantly on that. And the problems all look like they're addressable problems, because it's around the way the stores look, the number of people in the stores, the way they help customers, something about stock replenishment, about atmosphere in the stores, about them looking sort of modern rather than looking tired. Those are things which, with the spending of money and the loss of margin, which are genuine negatives, are potentially fixable, should be fixable. And what you've got underlying that is the fact that Tesco is far and away the biggest retailer in the country. It's almost twice as big as its nearest competitor, and it's got great locations in places where you cannot get planning permission to build competitive stores. So it's got a very strong moat, a very big moat around its business based on its store portfolio, and also the breadth of things that it offers, and not just in terms of its goods, in terms of food and non-food, but in terms of other things like its financial services arm, and insurance products it sells, and so on. It's a seller of many things to many people. It has contact with pretty much every household in the country, and it just seems to have lost its way through some lack of focus, and perhaps not spending enough money on maintaining its store portfolio in the right way. But those problems should be fixable. There doesn't seem to be any structural issue there. It's not as if that business is going offshore. It's not as if that business is moving, to be an internet business. They have an internet business themselves, which is doing well. So that would be an example of one that hopefully is fixable.
Yeah, in terms of the way that we improve our processes, we use a checklist approach. And when we started our checklist, it had 30 items on it, and today it has over 70. So every time, and we learn both from investments that we make and from also looking at businesses that we looked at in detail, maybe didn't invest in, but just by following that business, you kind of learn more, and we bring out little details from those and put them into a checklist. A good example recently is a business called CPP. I don't know whether you've come across them.
Perhaps for our viewers,
so CPP sort of sells what we would regard as unnecessary insurance products, which are sold alongside, typically through the financial services sector. Sort of insurance that covers things like
mobile phones.
Yeah, mobile phones, but overpriced, very high margin, and it's the sort of question that we've now got in our checklist is this a product that people really need? So it may be a product that people are successfully selling, but in the long term, is that sustainable? And that wasn't something we were asking, when we were looking at different investment decisions.
And there's the other side of that, which is also a factor in our analysis now in particular, is it a product that people really like? And you can encapsulate those two things in the Net Promoter Score, which is if you ask people the one question, would you recommend this to a friend? And you have an answer, 1 to 5, where 5 is high and 1 is low. A company which gets a lot of 5s, which has a very high Net Promoter Score, is going to have a good momentum behind it just by recommendation and so on. Whereas a company with lots of 1s is, in a sense, living on borrowed time, unless it's got some other big moat that protects it. So one would expect that if you asked a customer who'd been sold mobile phone insurance whether they would recommend it to a friend, they would have a pretty lukewarm sort of response to that. Whereas if you ask somebody who's got an iPad whether they'd recommend it to a friend, the answer would be yes, pretty much universally. And that can be night and day in terms of a business's real, its connection with its customers, but its long-term future.
Just curious, you mentioned the checklist, and it has about 70 items on there. How do you use that on a day-to-day basis? Can you tell us a bit more about how you go about, do you really go through all of these items on there before you make an investment?
Sure.
And, what are some of the other items on that checklist?
Well, obviously it's RIP, but they're fairly a lot of them are fairly obvious. Looking at making sure that we look at the pension arrangements within the business. A very big pension obligation is like a kind of debt. Generally, that puts us off the investment. A variety of different measures or qualitative checks that help us to think about whether or not there is a genuine moat in the business. Looking for things like network effects, looking for high embedded capex, which would be difficult to replicate.
Switching costs.
Yeah, switching costs, and then around management. So some things that we discussed around management quality. We go through. It doesn't actually take that long to go through a checklist, and what it does is it directs your. When we go through the sort of third stage, the heavy lifting stage of our analysis process, we go through that checklist as a way to direct our analysis, and there are typically 70% of them are ticks. There's no problem with that, and then there's another 30 that sort of help us to think about where we need to focus our energies in terms of understanding what the risks and issues are with that business.